Coming up on today's show, stocks rise across the board led by mega cap tech. S&P 500 nears an all-time high. Ahead of tomorrow's CPI report, US and UK warships shoot down more missiles in the Red Sea. The SEC's Twitter account was hacked, and a preview of the big bank earnings due out this Friday. Welcome back everybody to the Click Capital Daily Market Show. I'm your host Jared. Hope you're all doing well out there. And it was another mostly bullish day on Wall Street this Wednesday, ahead of tomorrow's CPI inflation report, and it was mega cap tech that led the way today. Another good day for NVDA, and we saw some breakouts from Microsoft and Meta as well. Tesla's still a little weak here, and we've got some continuing build up in crude and gas supplies, which brought the energy sector lower. Other than that, it was a bit mixed across the board, and just looking at the S&P 500 daily chart, we're within a stone's throw of all-time highs here, currently at 47.83. All-time highs at 48.18, about 35 points away, and that could get tested tomorrow if inflation were to come in a bit lower than expected. I'd say the stock market might get a bit excited with that. Or if we got a surprise uptick in inflation, we may get a big red candle that could change the tune here a bit, and maybe these bearish divergences play out. However, we'll just have to wait and see what the CPI comes in and how the market reacts to that. So the S&P was up 0.5%. Same with the Dow Jones, and the Russell was pretty much flat there. But once again, it was mega cap tech, those magnificent 7 stocks leading the way, with the composite index up 1.8% today. And that was thanks to the likes of NVIDIA rallying up here again today, finding new all-time highs at 546. And like I said yesterday, Microsoft was primed for a breakout. We got that today, just a few ticks away from all-time highs as well. And Meta breaking out to fresh yearly highs and not too far away from its all-time highs. However, Tesla was the softest of the bunch, coming down to this support zone around 230 here, where it has been holding that gap up we got back in November. And this stock continues to be the softest of the bunch and the lowest market cap of the 7 as well at 743 billion. But stick with me because I'll come back to the charts later after we go through some research and news today. So this market really is pricing in the soft landing, pretty much saying it's here already. And so the expectation is that inflation will come in line as expected tomorrow. And that is for the month of December, we should have only got a 0.2% increase month over month, and headline coming in at 3.2% year over year, just a little bit higher than November. But with core inflation, stripping out food and energy, expecting to decrease from November to 3.8%. And it's that prospect of inflation continuing its downtrend without anything major breaking that's given good reason for the bulls to get excited as kind of a Goldilocks scenario where rates can just come down, making stocks more attractive relative to bonds, on top of the continuing AI boom we've got going on that a lot of people are comparing to the internet from the mid-late 90s. And all those calls back in the mid-late 90s were right. The internet was going to change things massively, and it did power a good 5-year bull market in the late 90s. However, as usual, the market got ahead of itself, priced in the future too much, only for the tech bubble to burst in 2000 and the Nasdaq fell 80% over the next 3 years. So this AI boom could still have legs to run. However, like the internet bubble in the late 90s, this too could develop into a bubble that could eventually burst. It's just that no one knows how much further it could keep going for a couple more years. However, we can't forget the outperformance by tech stocks has already been going on for a couple of years. Here's a chart of the last 5 years of the 11 major S&P sectors, and we can see IT significantly outperforming everything in that time. And if you're wondering why investing's been hard these last couple of years, it's because every other sector has underperformed the S&P 500 this last 5 years. So unless your portfolio was 100% in IT, it's been very hard to outperform the market. And we've seen that even from the biggest and best in the business, hedge fund managers. Over this time, some of the most famous hedge fund managers have seen their assets under management get cut in half, even more, even have to shut up shop, as we've seen the rise of passive investing, as most of them haven't been able to outperform the S&P 500 over the last 5 years. And so while a lot of people own those stocks, Apple, Microsoft, NVIDIA, unless you have your whole portfolio concentrated in them, it has been very hard to outperform. And we all know the Magnificent 7 mega cap tech stocks are huge, been on an absolute run for many years now. But just to put it into context how big they actually are, the Magnificent 7 have a combined larger market cap than any single country's stock market except for the States. That is those stocks: Apple, Microsoft, Alphabet, Amazon, NVIDIA, Meta, and Tesla. Their combined value market cap's bigger than the Chinese stock market, the Japanese stock market, India, France, UK. And when you look at the two biggest stocks in the market, it gets even more crazier. That's Apple and Microsoft. They're currently sitting at about 14% of the S&P 500 index, And just those two stocks alone have a bigger market cap than the energy, real estate, utilities, and materials sectors combined at 11.9%. And look at little old metals and mining industry at just 0.2% of the S&P 500 index, absolutely dwarfed just by two tech stocks. If you were to go back in history just even 20 or 30 years ago, a lot of stock market veterans and the like would be absolutely shocked if they knew in the future just two tech stocks would be almost 3 times the size of the entire energy sector. It is a huge disparity and just makes one wonder how much further can this disparity go. Are we going to get to the point where these magnificent 7 stocks just make up 70% of the market or something crazy like that and just pretty much become the stock market? Or are we going to see a huge closing of this gap over the next couple of years and this historical disparity corrects itself? One thing that could bring on a correction of that disparity is if we did get a recession, that would inevitably bring down corporate earnings and likely stocks with it. And since it's such a concentrated trade in those mega cap 7, there would likely be a lot of selling in it. And since they're so concentrated in the S&P Nasdaq indices, could bring down the stock market, as we refer to it, quite a lot if that were to happen. Because we still have some Fed members saying interest rates need to stay high for some time to ensure inflation is tamed. That's New York Fed Reserve President John Williams. Said interest rates will likely need to stay high for some time until senior central bank officials are confident the rate of inflation is returning to 2%. So the markets will be really looking for that tomorrow to confirm that trend, because any surprise uptick in inflation is really going to upset the narrative going on through markets at the moment and could lead to a sharp repricing. However, going into the CPI report tomorrow, we've got Treasury yields holding steady. Yield curve still inverted with the 2-year at 4.36 and the 10-year at 4.03. And looking at Fed fund futures, pretty much a done deal. The Fed's going to hold when they meet later on this month with a 2/3 chance they're going to cut in March and keep cutting all year. So the expectation either way is inflation is going to come down. The stock market just thinks it's not going to happen with a recession. And there's a look at the 4-year chart of CPI versus core CPI. We peaked out in June 2022 with headline CPI getting up to 9.1% and has been on a downtrend since. And the Fed of the market wants to get down to this level, under 2%, and near the 10-year average headline CPI at 1.9%. However, just looking at this trend, we can see a bit of a slowing in that downtrend and stalling out somewhat over the last 6 months. Its pace of decline has slowed down. However, the market's convinced that this year it's going to keep tracking down to under 2%. And if that were not to happen, that would upset markets quite a lot, and we could see some big changes happen if that weren't to materialize. And the most volatile and variable input into inflation, oil, is helping the narrative of inflation coming down, as we saw a big build-up in supplies, both crude and gas. Oil supplies were expected to decrease 675,000, but actually got an increase, and same deal with gas as well, coming in way higher than expected, showing there's still plenty of supply out there. And so not even the continuing flare-ups in the Middle East like we just saw, with US and UK warships shooting down more missiles going after commercial cargo containers in the Red Sea from Iran-backed militants, and likely more action to come as the US is lining up strikes against land-based targets in Yemen to respond to these attacks, as its policy to make them all pay a price whenever they come after our commercial ships and try and disrupt global trade. We've just got US Secretary of State Anthony Blinken pictured here, trying to de-escalate things and prevent it from turning into a full-blown regional conflict, which shouldn't happen, as Iran know it's a war they can't win if they really want to step it up. And what's going to help counteract any flare-ups in the Middle East is US crude production is growing and growing. Last year, 2023, the US produced more oil than any other country in history for 1 year, and that's set to hit fresh records again this year and next year, as there's strong political will to de-risk from the Middle East and their oil, and adding even more downside pressure to the price of oil and increase of supply. Other Russians stepping up their production and exports, evading sanctions and not really wanting to go along with the Saudis, and they don't really have an option, as it's the only real way to keep their economy afloat, especially since they've cut themselves off from most of the West and really rely on the Chinese and other Asian nations to keep buying their gas. The Russian government and big business over there really needs those oil revenues to keep going. And just looking at crude oil seasonality, going back over 40 years, it pretty much followed it exactly last year. Got a bit of weakness to start the year, then we kind of rise out of February, going into October, and then we fall off going into Christmas before we see another little bump again. And just looking at the daily on crude, that's pretty much what we got last year. We fell off starting the year, actually bottomed out in March, then we rose up into October, and fell off going into Christmas before we had a little bump. However, unless we get a real flare-up in the Middle East, which I don't think we will, I think the US, the UK, and Western allies will shut it down pretty quick. I think there's a good chance we may actually take out this 67, 65 support in the coming days or weeks, just from the barrage of supply coming onto the market, and we've still got some weak global economic growth as well. Staying on commodities, we do have an uptick in volatility in natural gas, as we've still got some cold weather in the northern hemisphere, and the market's getting a little bit rattled with what's going on in the Red Sea. And the states actually produce more gas than they consume, and they just export the rest around the world, which is becoming a bit more complicated and expensive, with a lot of ships still diverting around the Red Sea, having to go around the bottom of Africa, which is a lot more longer and expensive route. We can see that in the price of natural gas futures spiking up yesterday, having a bit of a pullback today, and a bit of a bounce back in shipping rates after exploding off lows after we've got those attacks from the Red Sea. But just looking at the crude oil volatility index, OVX, hasn't really ripped up, still tracking at an annualized rate of 36%. So the situation's still ongoing and fluid, but at this stage it shouldn't boil over into anything major. And lastly, on commodities, we've got France dropping some renewable energy targets and now prioritizing nuclear in their new energy bill that favors the further development of nuclear power while avoid setting targets for solar and wind power and other renewables. And they hadn't built any nuclear reactors for a long time, but now they're talking about the sustainable choice of using nuclear energy as a competitive and carbon-free source of electricity. Targets construction of at least 6 but as many 15 new reactors to pull off the transition to clean energy and meet climate change goals. And for those of you who watch this channel know that I'm a uranium and nuclear bull, and it's good to see one of the world's largest economies, second largest out of Europe, moving more in that direction as they realise they've been way too levered to Russia for their energy needs. Something a lot of people pointed out to them for a long time, but they were willfully ignorant. And we've got a nice bounce back in the uranium ETF, hovering near yearly highs now, and this ETF still offers a good dividend yield of 5.91% and has positions in 47 uranium and nuclear related stocks. And I've actually got the uranium ETF NLR as part of my 2024 top 10 ETF picks, something I think could have another good year like it did last. And moving on to crypto, I'm sure many of you heard the Security and Exchange Commission SEC Twitter account was hacked, and the hacker posted a tweet that the SEC approved Bitcoin ETFs, sent the price of Bitcoin ripping up straight away before Gary Gensler, the chair of SEC, posted through his own Twitter account that that was not the case. And I'll be interested to see whether they investigate themselves for this, because this is what they do to other companies in similar matters. When other companies have a security breach and it results in market moving false information, they'll typically go after them and issue a fine or something like that. And so the drama of SEC and Bitcoin just continues and gets even more spicy. And it'll just be interesting to see if another government agency comes after the SEC, because apparently they didn't even have two-factor authentication enabled on their Twitter account. Or it could have been an inside job with an employee at the SEC whose mates loaded up on Bitcoin at the time he made the post. Who knows what happened? And it looks like just as I speak, we've just got approval from the SEC of the Bitcoin exchange traded products. There's an article just published by Wall Street Journal after market close. SEC approves Bitcoin ETFs for everyday investors. So it was widely expected to go through. Kind of funny they just do it the day after they got hacked, trying to clear it up and just move on by the looks of it. What's also interesting is now that they've approved Wall Street to sell Bitcoin ETFs, accept institutional money, they've done this only months after taking out the two biggest players of the industry, Bankman-Fried and Changpeng Zhao, CZ. FTX and Binance were the two biggest players in crypto up until this day. Now Wall Street's taken over. Regulators have paved the way to get rid of them, bog their companies down in legal proceedings and regulations. And now the likes of BlackRock and Fidelity will be the new kings of crypto, which is not so surprising at the end of the day. This is how Wall Street works. These products will only get approved if they can make money off it. But not everybody on Wall Street's so excited about it. Crypto public enemy number one, JP Morgan CEO Jamie Dimon, continues his crusade against it, slamming Bitcoin as worthless and a tool for criminals. However, he'll probably come around to it once his bank can start making money off it, which looks like they're already trying to start and do. With a surprise development not even 2 weeks ago that JP Morgan's going to be an authorized participant in the BlackRock Bitcoin ETF, and looks like they're dipping their toes in the water and setting up for more things to come. And so like the rest of Wall Street, once he can make money off it, he'll probably change his tune and say that he was wrong and made a mistake. And there's a look at the price of Bitcoin just hovering above 46,000, still on this solid uptrend that's been going on since October, and even more of a rip today in Ethereum, breaking out to fresh multi-month highs on really strong technical price action there, as that's probably what's going to be next in terms of institutional money coming in the door. So at the end of the day, it doesn't matter if it's a real currency, has real utility. It's all about perception. If a lot of people believe in it, and even if it's the greater fool theory like Buffett said, if you're not buying it for utility or yield, but just simply you think you can sell it to a greater fool at a greater price in the future, then that's all that matters, especially for Wall Street. If they can pump it up and make some money off it, then who really cares what happens to it in the end? And speaking of banks, we've got Q4 earnings season kicking off this Friday, starting with the big banks as usual. JP Morgan has been on an absolute tear these last couple of months. Got earnings expected to come in at $3.34 a share. That's actually down from the same quarter last year, where they reported $3.57. Same deal with Bank of America, expected to report 54 cents of earnings per share on Friday versus 85 cents for the same time last year. However, Wells Fargo is expected to show an increase, 85 cents versus 67 cents, same quarter last year. Overall, the financial sector is predicted to report the fourth highest year-over-year earnings decline of all 11 sectors for Q4, at negative 3.1%. What's really holding them up is the insurance industry, expected to report year-over-year growth of 26%. If you exclude insurance, financial sector is expected to show a decrease of 8.9% in earnings. Looking out to Friday in the next week, the market will be focused on the impact of sharp decline in interest rates during the quarter, the level and breadth of credit quality deterioration, and updates to 2024 guidance in light of lower rate and GDP expectations. And the market is expecting the financial sector to get back to earnings growth come Q1 this year, and it's expected to significantly grow into Q4. Moving on to the Fear and Greed Index, the stock market is still technically overbought at 75. And corporate insiders are coming back from holidays just to continue with a bit more selling, not really doing much buying up here. And just looking at breadth, we've got a little bit of a pullback going on. Just over half of all stocks above their 20-day average. 244 stocks breaking out to 52-week highs versus 68 stocks and ETFs breaking down to 52-week lows, led by China once again. Option dealers don't see any problems on the horizon. VIX still super low at 12.6 with only a little bit of volatility risk premium. Got TLT pulling back to its 50-day VWAP for the first time in a couple of months, while we've still got high-yield bonds performing a lot better. There's the dollar index still on a bit of a downtrend, and there's gold still in this all-time high resistance zone. And the longer we go without breaking out, the more chances it does have for a bit of a correction. There is a bit of a bullish consensus on it. We're so close to all-time highs, so I'm really not sure here. It just seems constantly flat every time we push up against these all-time highs. Really need to see a good clean breakout and hold above this level for it to establish a good bullish trend this year. International stock indices mostly flat on this Wednesday. Got a good rip up in the Nikkei 225, best performing index year to date. And believe it or not, it's still below all-time highs it made back in 1989. Stock market's gone nowhere for almost 35 years, even worse if you adjust for inflation, and that's because Japanese stock market just got so ahead of itself in the 1980s. Actually got up to a PE of 100, which I think was a historical record for a major stock market. However, 35 years later, at a much better valuation, and that's why we've seen over the last year or so the likes of Warren Buffett putting on one of the best trades of his career, selling Japanese bonds for around 1% and then taking that money and putting it into Japanese stocks. Short bonds along the stock neutralizes the currency risk and it's a self-financing trade, which has worked out fantastically so far. Moving on to spread charts, we've got the growth versus value spread still holding up there. Bit of a pullback in small caps versus large caps. Commodities continuing to underperform versus stocks, and those inflation expectations flattening ahead of tomorrow's CPI report. Best performing stock sector today was robotics and AI, followed by the home builders, still doing really well here in an uptrend. Worst performing sector was clean energy, really volatile stuff, still trying to find a low down here. Oil and gas still on a downtrend. Is biotech still continuing its big bounce off the bottom, and the defensive sectors still trading pretty good as well. Healthcare, staples, and utilities. Let's look at my 2024 ETF picks. Bit of a soft day, led by cannabis. Still super volatile, still waiting for some good developments in legislation to come out. There's a look at the Mag 7 led by Meta today with that breakout we talked about earlier, and we've still got others like Alibaba flirting with that support levels and low 71s here. See whether that can hold or we go down into the 60s. And overall, regional banks and the big guys still holding up pretty good going into the earnings season that they start off with. Alright guys, there we have it on S&P 500. About 35 points away from all-time highs going into a CPI report tomorrow. Market is pretty benign, not really moving a whole lot, except for mega cap tech, which is breaking out to start the year off. And we'll see what the CPI report brings us tomorrow and how the market reacts to that, as it's still expecting inflation to come down and the Fed can reinforce the view that they're done hiking rates, and then the next move will be a cut possibly in March. We'll just have to wait and see what we get. Thanks very much for tuning in to Click Capital, and I'll see you again tomorrow night for my analysis of the CPI report. Thanks very much. Cheers.